It's beginning to look a lot like 2020 right now. And I'm going to show you these charts here that you saw on my thumbnail. Pretty crazy stuff. Yesterday's video, we talked about the possibility for a pullback. I think that we all saw what happened today, a pretty gigantic move, a powerful move, but then it was immediately purchased back up. We're going to cover those levels. If you're new here, welcome to the channel. My name is Michael Silva. I do these daily stock market briefs Monday through Friday. We use technical analysis to get a good idea as to where the market might be headed next. We look at multiple different things, okay? Not just technical analysis, we use intermarket analysis. Intermarket analysis allows us to look into multiple different asset classes to help paint a better picture of the macro view of what's going on in the market. So in today's video, we're going to be covering sector rotation, a couple different sectors, and then we're going to go into the indices, indicators, commodities, dollar, bonds, yield. Buckle up. We got a lot to talk about. Let's get into today's show. Alrighty, welcome back. Before we start diving into everything, first let's just bring up the post-election seasonality chart so you get a good idea as to why I've been saying, another reason as to why I've been saying, I should say, that there's a possibility for pullbacks to take place in February. Not only did we mention yesterday they were coming to the upper portion of the channel or hitting into that line of resistance, but there was also the VIX that was signaling coming into an area of support. And then we also, I want to match this in with the post-election seasonality chart for the S&P 500. You can see in February we have it go up and then typically down and sideways into March, and then see some pretty significant moves in April. So if seasonality plays the same script, yeah, it's a lot different now than it was 2 years ago or 3 years ago or 10 years ago or 20 years ago, right? It was a lot different then than it is now, but it's still important to look at what typically has it on a seasonality perspective so we're not caught off guard. Now, you noticed the thumbnail, right? Well, there's a lot of similarities going on with the S&P 500 and various other indices. But what I'll call out here is the SPY. Now, you might be looking at this and be like, wait a second, that's not 2021, but it looks like it. You're right. You're right. We're going from November of 2019 to February, or basically into March of 2020. Now, what happened shortly after this candle? Well, we had a pretty significant gap down, significant move lower, and then we started having that February crash because of the whole pandemic. Okay, so this looks very similar to the structure of this. This is current chart going into 2021. So November, we see this ramp up, this kind of just slow grind higher and higher, and this was obviously the election boost that we got right there, slow grind higher and higher, and then this somewhat significant pullback that scared some weak hands, but then bounced at the 50-period moving average into another area of support, which we've been talking about. And now we have this kind of ramp up higher and creating another little hammer candle. Okay, let's go back here so you can see kind of ramp up higher, significant pullback, scared some people. Phew, we had a relief rally. Good stuff. Well, I mean, just it's insane how similar the price action looks. And I'm going to show you actually another chart to kind of help you really see this picture. But relentless move up, the same time frame, right? In February, then we had this scary move to the downside, and then pow 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 gap up. And this is current, and then we go back, pow pow pow, move up, scary move, pow pow pow, move back up, hammer candle. So it's just very similar. That doesn't mean that we're going to have the same exact thing take place, but you just need to be aware that the price action here is actual real data, right? So this is markets buying and selling. It's algos buying and selling, hedge funds, individuals, you name it, buying and selling and printing in, this data that we see in these candlestick charts. Now, history doesn't always repeat, as Mark Twain says, but it often rhymes. And this is a very similar rhythm around the similar period in time. All right, so let's look at a map, zoomed out a little bit on the daily time frame, 2020 to current right here. You can see this is the dinosaur pattern we were talking about in previous videos. You got 1 foot, 2 foot, and then the long Brontosaurus neck right there. Brontosaurus. I was about to say Brontosaurus Rex. I don't think that's a dinosaur. Oh boy. And then we got it right here. 1 leg, 2 leg, and a long neck going up, and then all of a sudden puked out below that area the blue line, which was clearly a support right there. Now we have this support. It would acted as resistance, support, and we moved up. So you can just see here the similarities in price action. We had negative divergence on the RSI then, and we also have negative divergence here on a little bit lower of a reading. So it's just something I wanted to bring to the attention. I've already brought it to everyone's attention, but I wanted to paint a more dynamic or more visual image so you can visually see where we're at and be like, okay, well, shoot, our 20 period moving average is moving up, our 50 period is up, our 200 is up. I mean, look at it right here. 20 period was up, 50 period was up, 200 was up, about the same spread between these two, and then these two, same spread between these two and these two. Pretty crazy, right? It's very similar, and yeah, we have unlimited quantitative easing since this pattern, so things are different, but the price action is very similar, and markets tend to respond and act in very similar fashions. You can see these patterns take place throughout history, various different patterns, and that's why we use technical analysis. We're seeing something very similar here take place, but that does not mean at all that the market's just going to roll over, but you need to just be aware that the patterns here exist. Now, yesterday, energy was at the bottom of the sectors in the S&P 500. And what do you know? We were talking about the possibility to see it, a good buying opportunity, and bam, energy right back up to the top of the list. We looked at a rotation graph. Now I want to dim it, or kind of like slim it down a little bit, or zoom in a little bit, I should say. It was a weekly time frame. We're looking at 13 weeks. Now I'm just going to bring into a daily time frame for 7 days. You can see XLE, which was leading the way at the main leader on the weekly time frame. But now you can see here from a weakening perspective, and it's heading into that leading, is kind of rotating itself back in there. So that is a good sign for energy. And we also have XLF, the financials, going from a lagger to an improving sector. Now, like I said, this is a shorter term, so just keep that in the back of your mind. This isn't what we used last time, which was a more pronounced trend, 13 weeks on the weekly time frame. So these are just days going by, but it is improving nonetheless. And now let's look at the sectors and the relative strength charts. I pointed out this inverse head and shoulders on energy. You can see energy is putting in higher lows here, and it still has a lot of room to go to meet back even to its 2020 high from a relative performance standpoint. So this to me still looks like the standout sector. Also, what I want to call out here is financials. Financials is running into an area of resistance. Clearly, it hasn't came back to the 2020 high, but it has this cupping kind of pattern formation, and it had some resistance up in this area from a relative strength performance. All right, so this right here, the top chart, is the daily candlesticks, our OHLC bars. And then down here is the relative strength of the financials divided into the SPY. So when this goes down, that means the SPY is outperforming the financials. But when it goes up, it means financials are overperforming the SPY. Now, I want to show another chart of a bank index. This is a large bank index, the BKX. And we called this in previous videos the red zone, because every time the price action moves into the red zone, something has taken place, not for the good exactly. It's been acting as a wall of resistance. That might change, but you can see here in 2004 when we started lifting the Fed's funds rate, you can see financials, the BKX, moved into this just area of resistance. And then bam, we had the financial crisis. We had the rates crushed down to zero, and you can see we held them there for multiple years, and they started to climb back up into this area of resistance. Well, we all know what happened in 2018. We started to try to taper the balance sheet, and clearly that didn't work, so we saw another scare to the downside, but that's okay. We started climbing back up into the red zone, and then as soon as we got up into that area, we had to slam rates down again because of what happened within the pandemic. Now we are already slammed to zero for the first time, reaching up into this area. So maybe this is the time where this turns into an area of support. The only other tools that we had during this time was to lower rates, but rates are clearly down to zero. So from here, here, and here, it's clearly a different time. Maybe we break through. This previous month candle was a nasty gravestone doji, which means it was really bullish, but the bears really stepped up when we got into that area. And now I just want to call out, we're moving back into that area. We're seeing very similar patterns as we've seen here in the price action. And yes, the financials have a large weight. They mean a lot to the equity market. So it's important to track the financials and the banking index. Now, whether this breaks out to all-time new highs, that is we don't know yet, but we will be keeping a close eye going forward. Now let's just go ahead and hop into the indices, starting with the S&P 500 daily time frame, right? We ran into this upper channel. We talked about the reasons why in yesterday's video. If you want to go back to yesterday's video to hear what I said and why I said, hey, pump the brakes, it's because it didn't give us a clear signal that we'll see continued strength. We had the small range candle and we were coming into an area of resistance. We looked at the VIX and everything just said basically, okay, it's either consolidate or, pull back, maybe break out, but it didn't seem likely. All right, so we're still here at the upper range of the channel. Hammer candle, you could technically call this a hanging man candle because of the forceful move to the upside. And then we saw some bearish action intraday and the bulls immediately bought that back up. But there's a reason why they bought that back up. First off, they filled a gap and gaps act as support on the 30-minute time frame. You can see we ran into the 50-period moving average. We talked about this the other day. And now what's interesting is you can call this a potential bear flag. So watch for a breakout below the bear flag and potentially going into tomorrow to fill this gap beneath us, maybe more if it does continue to do that. But as we've seen so far, we've had an aggressive gap up. That gap was filled, then a continued move to the downside. That hammer candle I called out on Twitter saying, okay, that got bought back up, so I wouldn't be surprised to see the price continue to move higher. But I said, do watch out for the dead cat bounce. We did backtest this channel, and we continue to use this area of support now as an area of resistance. So pay attention going into tomorrow. If we break back into the channel and then start having 392, 393 be another level of resistance, or if we start breaking down. Let's go into Dow Jones. Dow Jones daily time frame didn't give us much. We did close at another all-time high. Holy moly. But you can see here a very, another indecided type candle. We back tested this area of support, that 2050. We did say, 31,250. We did say previous days where, hey, if we break above this resistance, we kind of just went sideways for a while before heading higher. Well, we broke above this. We're not seeing any, strong volume just spike us way back up into it. We're kind of trading sideways. So will we get above 31,500? In my personal opinion, the Dow Jones out of most of the indices right now does seem like it can push a little bit higher. We did map out on previous videos the descending broadening wedge pattern, and I put out the target for 32,000, and we're still got some room to go, but I did call that out more towards down in this range. So it has made a pretty aggressive move fairly quickly. On the 30-minute time frame, you can see that we gapped up, and that gapped above our previous resistance that we had mapped out yesterday. All right, we had it right here, so I moved it up a little bit, but immediately came back down. And guess what? If you were paying attention, 312.50 was just spot on for an area of support. It immediately got bid back up and then created that hammer candle. We went sideways and moved up higher. And then this now is acting as resistance. We have the high of the day, which was 315.24. So you can call it 315 or 315.50, whatever you feel most comfortable with. But just keep in mind, I'm keeping an eye still on this little channel from, the high of 315, 315.50 to a low of 312. We still have these gaps. So, keep in mind, if we break through 312.50, we can still, tap the low end of this gap and potentially bounce from there as well. Let's look at the NASDAQ 100. We're going to take a look at the Qs. You can see hanging man candle, definitely an outside trading day as well at the upper range here. We have the price percent oscillator kind of, curling itself over. That could be somewhat bearish short term, but in longer term bullish context, you can see the 20, the 50, the 200 all sloping up. So we can still find support at the lower range of this channel. The immediate downside risk, I'd say, is more 325 to about, 324 for the immediate term. So nothing too crazy right there. Still overall very strong looking. On the 30-minute time frame, I'm going to be looking at 330 for support if we break down through this kind of bear flag. If 332 holds, we'll probably go retest 335 on the 30-minute time frame. Now, if we start breaking above 335, that can give us an extra burst of energy. Now, I don't know if we're going to gap above it. If we gap above it, be careful because we might see something very similar to what we saw today, where we had that gap and then just roll right back down pretty aggressively to the downside. Let's look at the Russell 2000. Russell 2000 channel. I drew that out. Obviously, we finished a little bit lower outside trading day as well. Bearish price action, especially when you're coming at the upper range of a bull channel here. But it's short term, right? Where overall context is bullish. So the immediate downside here is to fill this gap and maybe come down to 220. All right. So that's what we're going to be looking for. And you can potentially hedge long at those areas, but you got to just make sure that you're putting stop losses in place because we are dealing with a very overextended market, a lot of euphoria. So you must be very careful when you do place these long hedges or even short hedges for that matter. You need to be careful because, we've been seeing just constant rips higher and higher. Still 40% above the 200 period moving average. That's a pretty large extension past that. So I wouldn't be surprised to see this thing just fall apart and start reconnecting, filling some of these gaps. But as it stands right now, it's going to take one gigantic bear to be able to knock down this gigantic bull. 30-minute time frame, we broke down through this short-term channel. We retested and tried to recapture it, but you can see we broke down through that little bear flag, and then we found some support right here at about 226, and we're still above the 50-period moving average, still above the 200. So if we start breaking down below 225, maybe then we start another leg lower to about 222 to 223, which would be this next gap. So we need to watch out for that. If we do gap up higher, we're going to have some resistance right around 229 to 230 going into tomorrow. Let's look at some stock market indicators. Only going to go over a couple of today because, I've just been talking so much. Let's look at the VIX first. Look at this. The pink box that we said, okay, when it comes down into this pink box, this is where you'd want to start pulling profits. Well, guess what? We tapped the very bottom of the pink box. I kept it here just for illustrative purposes. And then we, bounced right back up through that. Where did we find resistance? Well, we found it at the trend line right here that acted as resistance prior. So what can happen? Well, right now, that was a pretty indecisive looking day. All right, we have a small little body and we have the same size upper wick, same size lower wick. So there's a lot of indecision going on here. First off, we do have a lot of force to the downside. We came into this resistance and we broke down through this support, which then becomes resistance as well. So what it looks like to me is we can potentially see it go sideways but maybe potentially even fill this gap if we continue to scream to make new highs. But we need to be prepared for a potential breakout of this trend line again because we could see a volatility spike. Now, if we start seeing a volatility spike, we can start looking for more long positions right around 27.5 or even back up here at 37.5. We got to play that when it actually takes place. We got to be careful with that. And then also, if it starts to drift lower, expect to see either consolidation or maybe small pullbacks, nothing too crazy, and some just, basic consolidations. But if it does start coming down to this low portion, 17.5, that'd be the lower end of this range, and it would also fill this gap right here. And I would imagine that we would see potential moves higher if that was the case after that. But we're not there yet. We saw clearly a lot of volatility both in the upside and the downside today. We still are curling this RSI over, so keep this a little kind of curl over. Maybe we start getting above 50, we can see a stronger spike. Here is the null, the new high, new low. I just wanted to call this out. Just look at this super aggressive reading the other day. So it updated, 700. I look back at a chart going back to 1996. So I pulled up 25 years. I can probably go back further, but just ridiculous, crazy spike to the upside here. When you get overextended readings, you can get some pretty significant pullbacks. All right. So I just wanted to call that out. You can see the comp Q, which is NASDAQ. Clearly it's, pushing its all-time high. This is just screaming high. You can see when we had like this high over here, that was a 2000 peak. Was it like, that right there, 400 is a high reading, right? So you can see we tapped it just about down pull. Here we were tapping it. We were moving up, but then boom, downside. Here, even here, we see some, little spike to the downside, bam, to the downside here, bam, to the downside there as well. So, it's just something to call out. Doesn't mean anything's going to take place. It can read these high readings for periods of time. You can see the next 2 days following that, it was still a very high reading. But just know that is a very, very aggressive reading. And from a contrarian standpoint, you'd be looking at this like, yep, nope, I'm backing off. I'm taking some profits. I'm going to start pumping my brakes here even more. From a contrarian point, from a bullish standpoint, you can just say, oh yeah, this is just, super high. We're making all-time highs. We're going to probably see this consolidate, hold, and continue this trend. But I don't know. It can go either way there. I personally, when I look at that kind of a reading, I look at it as overextension and more of a contrarian standpoint. Breadth died off just a little bit today. Still a negative divergence here. Negative divergence as we were making all those new time highs. This is the NIMO, by the way. I use this to look at breadth in the market. I find it to be pretty helpful. And I also look for overextensions to the downside or the upside. Let's look at sentiment some more. Okay, the VIX kind of gives us some sentiments. The fear indicator. Here is the AAII Bulls survey, and then the bulls over bears ratio down here. Look at February 2020, bam, negative divergence on the ratio and the surveys. Same here. It's been building since November, and then same here on the ratio as well as we continue to press to make all-time highs. That doesn't mean that, we're going to see a pullback or a fall by any means, but it is just something to take note of. It also happened here in 2018. You can see the market went higher. We had the negative divergence. So the sentiment has been dying off a little bit since November, but just take note that we are still pushing significant new highs. And also, actually, by the way, when it reached this level, that was a very high reading, just so you know. A very high reading. That's why I have this red line up here. It shows us overextended readings. That was pretty darn overextended. Sentiment was just basically saying, like, everyone's bullish right now. And clearly we saw that move continue. But now, you can see it as it's dying down a little bit. All right, let's get into commodities. Gold first. Gold, tap that upper trend line right here. We've been matching inverted type hammer candle, and that was followed by a previous day too like that, coming into that area of resistance. This resistance right here has a lot of confluence. It has the 200, the 50, and this trend line. It's going to be very hard for gold to get above that, but if it can, that could be a very, very good sign for gold. But we'll see. It does have a positive divergence here on the full stochastics. We'll just monitor this as time continues. If we start breaking below 1760, 1780, that could be a little bit of a cause for concern for the price of gold. That means we'd be putting in another new low. From December's low, we'd be breaking in lower lows, lower highs, so the trend would still continue to be down. Here's silver. Silver, a little bit of a down day today, down 32 cents, 1.18%. We're back below the 38.2 fib level, but we're still above the 50 period, still above the 200. So is the 50 period going to hold? Are we going to kind of bounce around back and forth, continue to kind of create a cup pattern right here? Very possible. We'll watch to see if it starts breaking down through these key levels. A big key level to watch out for is the 61.8% fib level. That's at $25.16. So we'll keep an eye on that. Bitcoin, let's check in on that. Yesterday we talked about the big breakout, but then the potential for the breakout to come back test, and it does look like it's heading back to back test 42,000. If it can reach it, maybe we might be consolidating more sideways, creating a bull flag, or back testing the be right back trade, and then bam, continue to make some more highs. Play it carefully. If you do play the 42,000, I would consider having a stop below that, and then potentially watch out for 38,000 or even the 50 period moving average if it continues to fall. But overall, just a very aggressive move up to the upside. Now it's probably just taking a little breath before it decides what it wants to do next. The last one I want to point out on the commodities is WTIC, crude oil. Just look at that after breaking out of this kind of channel here, pow right to the upside. Are we going to see this thing consolidate again and pow even further? It's very possible. It's in bullish context, above the 50, above the 200. It's been screaming higher. RSI is pretty darn frothy. It's overbought. I wouldn't be surprised to see it pull back a little bit or consolidate, but we will see what takes place with this. This is probably helping out the energy sector quite a bit, watching just this aggressive move from February, just green day after green day after green day, continue to move higher. It's been something to watch and something to be a part of too on individual stock names. Now, the dollar is important to watch because, well, people were watching this falling wedge breakout. It was on the weekly time frame. This is the daily time frame. They're like, it's the start of something. What have we been saying? 92 handle. Okay, that was what we were monitoring back here, and we said, okay, if it starts breaking down, right, then it can have a more aggressive move to the downside. And bam, it really did have a pretty significant move in a short period of time. Then we broke out to the upside. We haven't even retested it yet. You're going to wonder what these pink lines are. That's to just kind of demonstrate the stair steps down, the lower highs, lower lows in play. The 200 period, 50 period is sloping down. The short-term 20 period did curl up, but now the price action's back below it. So in the last 4 days of trading, we've seen a pretty aggressive move to the downside for the dollar, but the move isn't over yet. This could be a period of consolidation. If we start breaking below this low, then that would be, you know, something to watch out for, especially the speed of the move. The speed of the move really matters here because that can shake, you know, and rattle the markets significantly if we do continue to break down through these levels, but see just a powerhouse moves, big red candles like we've been seeing these last 4 days. If this right here, you know, take these 4 days, if that happened like this, boom, 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 for the next 8 days, the market would take notice and they'll be like, what's going on here? There would be something, you know, it would be all over the news. It would be very, very aggressive. Even the 92, when we broke down from it, we started to get a lot more coverage on the dollar. So I think the same thing would be if we start seeing aggressive moves to the downside and breaking through this low. And also keep in mind, if we break above 92, we might see shorts have to cover. And this is a big shorted trade. You know, it's heavily crowded, they say, on the short side. So if they start covering, hey, you never know, that could be a pretty significant squeeze, and we could potentially even go to 95, 96. That would be pretty insane because that would put some pressure on like commodities, right? That would put pressure probably on Bitcoin. We've seen Bitcoin perform well since it broke down to the downside. So maybe it'll perform poorly if the dollar breaks up to the upside into that 95, 96, and potentially even the equity markets as well. Now let's look at bonds, okay, and yields. Not too much going on there. We're at 1.15 on the 10, 1.92 on the 30. The spread, nothing's changed there. We are still putting in higher lows. Just keeping an eye on this, so I'm not going to cover it too much, but we do want to look at this every day just to see if we see any aggressive moves. Like here in 2021, when we saw the 10-year spike up really quick, that really did affect gold. You saw gold run into an area of resistance, and then it really fell down hard as soon as this thing came into its little support here and spiked up. So, you know, that's one reason why we can be looking at this. Also, keep in mind, when these things continue to rise, that's good for financials. It's good for banks. So we've been seeing banks perform well in 2021, or even in February. This month, we've been seeing them perform well because we've had a move up here in yield, so you can make that connection. So it's something to just kind of monitor. If we start breaking through these trend lines, maybe then it would be more of a cause for concern. We'll keep an eye on that. TLH channel to the downside. We had this big volume day. Last time we had big volume, but it was at the upper range of the channel. And then we saw the pull back. We mentioned that. And then we saw big volume come in here at the bottom range, and we saw an up day. So that's kind of interesting. Maybe this starts to bust up from this, but also, you know, you never know, this could be putting in a bear flag and we start heading lower. It's too hard to determine at this particular point in time, but this was a pretty solid looking candle comparatively to the last 3 trading days at the lower end of this range. So hey, you never know. If we start breaking above 156, I mean, this is that kind of a move would be putting pressure on equity markets. Notice this channel, okay? Let's make a comparison here. This channel on the TLH, the 10 to 20 years, it's at the bottom range and it's trending down, okay, back to August basically. But if we looked at the daily S&P 500, right, since November, we've been in this up channel and we're at the upper range of this. So it'd be likely to see, now probably not in just like perfect fashion, but it'd be likely to see if we see this move to the upper range of the channel, we can see the S&P 500 move to the lower range of the channel or potentially even break down. So watch for that correlation to take place. All right, everybody, that is all I have for you on today's episode. Just to kind of round out my thoughts here, I am being very careful. I lowered a lot of my positions. I shared them on Twitter, but I'm still looking for profitable setups as time continues because you just never know. The market can continue to rip higher and you can make a lot of money during these times. We mentioned seasonality. So we got to be careful for seasonality. We got to be careful for this price action pattern right here that's very similar, okay? We need to be careful when we see the banks coming into this area of resistance. We need to be careful in all types of manners. We also, what we mentioned was the S&P 500. The S&P 500 channel that it's in and various other channels that we've been seeing are at the upper range of them. The VIX a little undecided. So if we do see a spike in the VIX, you can expect to see this head a little bit lower. Like I said, also want to end, it could be a period of consolidation. It's very hard to tell. I know that I get some calls right, and then I say some stuff that doesn't play out right, but that's the markets for you. What I want you to do is understand the bearish point of view. I want you to understand bullish's point of view, and I want you to stand on the edge of that coin so you can visually see and kind of take emotion out of the equation and just work what's best for your particular strategy. That's why I'm here, just sharing my opinions. Hope everybody has a wonderful day, and I'll see you back on the next episode.